Veeva Systems is up more than 500% since this company came public in 2013. And if you like high growth, high profits, and founder-led businesses, Veeva could be you. So here's everything you need to know about this business in 5 minutes. Thanks to StockCard.io for sponsoring today's video.
Veeva is a $37 billion software as a service company that trades under the symbol VEEV. That's V-E-E-V.
The company's mission statement is to assist customers' mission to advance human health and well-being. Not our favorite, but believe it or not, this is much better than it used to be.
That's true. Now, if you want to understand the company, it breaks down into two parts. The first is the commercial cloud, and you can see the 4 areas that the commercial cloud deals with. This helps life sciences companies communicate with their stakeholders after a drug goes public. The other side of the company's business was developed later, and that is Veeva Vault. This is what life sciences companies can use internally to track everything that a drug needs to go from the idea stage all the way through FDA trial.
Veeva uses a software as a service business model to sell its products and tools to market. The vast majority of this company's revenue, 80%, comes from that subscription revenue. However, the company also derives professional services revenue for about 20% of its total top line.
The company has a net revenue retention rate of over 120%, meaning it does a great job of holding on to existing customers and getting them to spend at least 20% more every year.
The company does have to pay up to acquire new customers, but as a percentage of gross profit, that number is a very low number, which makes this company's customer acquisition costs fairly low.
And because this company focuses on the life sciences industry, demand is relatively recession-proof. The company does have a weak network effect because everything is stored on a Veeva cloud. It's easier to share information if you are also on the Veeva cloud. Again, a weak moat.
But Veeva's primary moat is its switching costs. Once a life sciences company adopts Veeva's tools and starts to use them, it becomes a huge hassle to switch over to a different provider.
And because over the last 5 years, Veeva has dominated the life sciences industry, it now also benefits from some brand value.
Importantly, the company is rolling out new products and new services and adding new customers all the time. That makes us believe that Veeva's moat is continuing to strengthen as it grows.
Even though Veeva has captured a large section of the life sciences market, revenue growth has continued to be solid, growing at a 31% clip over the past 3 years.
Since Veeva is primarily a software as a service business, its gross margin is very high at over 72%. And because this business is relatively mature, it's reached a stage where it's already producing healthy amounts of both net income and free cash flow.
As you can see, the balance sheet is also very healthy with lots of cash and no long-term debt, and the company gets solid returns on capital.
Veeva was founded in 2007 by Peter Gassner, a former Salesforce.com executive who left to found a company that could focus specifically on the life sciences industry. Peter Gassner is still the CEO running the company today.
Gassner's reviews have improved markedly over the last 5 years, and the company has also been one of the first publicly traded companies to transition to being a B Corp.
Even today, Gassner continues to hold a sizable amount of Veeva's stock, owning more than 13% of the company, which makes him a multi-billionaire on paper.
Veeva has a ton of optionality. Within the life sciences industry, they roll out new tools that these drug companies can use on a quarterly basis. But the company's also looking outside of life sciences and seeing if its tools can be used in heavily regulated industries like cosmetics, chemicals, and consumer packaged goods.
While the company has already benefited greatly from operating leverage, there is still a bit of room for it to improve its margins over time. However, on that basis, the vast majority of the gains are behind the company.
Veeva estimates that it's chasing about a $13 billion opportunity, of which it's gathered a sizable chunk, but that could expand markedly if they experience success outside of life sciences.
And to achieve that growth, Veeva has not been an acquisitive company. The vast majority of the company's revenue growth has come from organic means.
Veeva's stock has absolutely spanked the market since it came public and over the last 5 years, and the company has consistently outpaced analyst expectations.
So far, Veeva has not focused on capital returns in any way, but given the company's stage of maturity, it's possible that it could start to focus on them soon.
The most important risk that investors need to be aware of comes from competition, which is at a medium-high level. IQVIA and Oracle are two of the names to look out for.
Veeva used to have some serious customer concentrations for investors to watch. More recently, the company has added so many customers that that's no longer a big concern. However, one company does account for more than 10% of the company's accounts receivable. Not sales, accounts receivable.
And finally, to get a high-quality company like Veeva, you need to pay up. The stock is valued at about 24 times sales and nearly 45 times free cash flow.
So how can investors tell if this thesis is on track? First, keep an eye on new verticals. The company has been targeting the consumer packaged goods, chemicals, and cosmetics industry. Those are new verticals that the company is having early signs of success in.
Second, we need to keep an eye on operating leverage. It's already pretty high, but we would like to see profits continue to grow faster than revenue.
Third, keep an eye on the company's net dollar retention rate. We want to see Veeva not only add new customers, but keep the existing ones spending more and more every year. Importantly, it's worth noting that Veeva only releases this figure on an annual basis. So how did Veeva score on our investing checklist? The answer is excellent. On my investing checklist, this company got an 85. That is well into my high quality business range.
And on mine, the company got an 11.5. It's a huge improvement from before, and most of those improvements come from culture improving at the company using the metrics that I'm able to use.
All right, Brian, both of us give Veeva the thumbs up in our portfolio, so it's time to head on over to stockcard.io to hold ourselves accountable. I'm in the anti-fragile portfolio, which is your thumbs up portfolio, and I'm going to add it. So the ticker symbol here is VEEV. We're going to do a buy decision. Today's date is Monday, January 17th. This is a $223 stock, so we're going to buy 5 shares, and this scored an 11.5 on your framework. Next, we're going to head on over to my portfolio, which is the Brian Feroldi quality checklist. We're going to add a new order and do the exact same thing.
And while Brian's doing that, we want to remind folks that you can not only check out these portfolios at stockcard.io, but you can enter our 2022 contest where you pick 5 stocks to try and beat the 2 of us. The best returns will get a $1,000 prize at the end of the year, with smaller prizes on a quarterly basis. We also want to mention, with nearly 400 portfolios submitted so far, there are 5 stocks that stand out as community favorites, and they are Upstart, ticker symbol UPST, C Limited, SE, Tesla, TSLA, Mercado Libre, MELI, and Unity Software, ticker symbol U. Worth mentioning that 3 of those stocks are within our 10 that we chose for our portfolios.
Overall, both of us clearly believe that Veeva is a high quality business that continues to beat the market from here. Brian's out.